Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, April 16, 2015. Inside the numbers tonight, we're going to discuss the SPY and the E-mini. We're going to cover the wall of worry, what that is, and what the next move is, because whatever it is, I have a sneaking suspicion. Actually, it's more than a sneaking suspicion. We're going to see a large move coming. We're going to talk about crude oil, where we are. We'll talk about the gold market, the interest rate in the bond market. Actually, we're going to skip that tonight because there's nothing new. There's no trade. We're in the middle of a range, and that's the end of that. No new information from last night. And then we'll talk about the U.S. dollar, and that's doing exactly what we said it was going to do. So here we are in the SPY, and we had basically a nothing day today. It was quiet. There was light volume. It's options expiration week. There was no catalyst to get the market really moving in one direction or another. And if you look at the intraday movement on the spider chart here, you can see that the range was relatively narrow, down to, let's call it 209.77. Well, it wasn't that narrow, up to 211. So basically it was about 15 points, give or take, on the S&P. But needless to say, it was so quiet. There was no real heavy moves one way or the other up until the late afternoon. Market started to sell off a little bit. But there's nothing to read into that. Some stocks were up, some stocks were down. There's just nothing new. You know, with light volume market, you can't short a light volume market. I think, well, so let's get into the wall of worry, right? So there's really no new information in the S&P. Where are we? Well, let's flip over to the E-mini contract. So here's where we are. I'm going to give you the numbers. They're kind of like bookends, and it's going to be a real simple scenario. Let me go, and then we'll talk about the wall of worry. Let me go over to the daily chart. I'm going to make this so simple. Right now, so what we have is, if the S&P E-mini closes hourly below 2090, okay, we're at 2,150 cents now. 2090 hourly closes below 2090. The likelihood of us going down to first 2077 and then 2070 increases dramatically. And then if there's any velocity as we get down there, there could be lower prices ahead. So what I'm trying to say is an hourly close below 2090 is bearish for the market for the short term, meaning a day, within the day, 2 days, that type of thing. Not weeks or months, just over the next, period of time, short period of time. On the flip side, any hourly close above today's high, which was 2104.75. So say an hourly close at 2105 or higher is very bullish for the market, and there's higher prices coming. And the first higher price coming is about 2115 to 2120, in that neighborhood, and then higher than that. So there's the bookends. It's 2090 or 2105. Anything in between there is really no man's land, and there's nothing definitive one way or the other. So that's a pretty good scenario for traders, right? We know exactly where our spots are. We know the downside, we know where to get bearish, we know where to get bullish, and we know if we just bounce like a pinball in between those two numbers, there's just no trade. It's that simple, okay? So the wall of worry is pretty simple. The news media loves to talk about negative stuff. So case in point is tonight, this afternoon, today it started to trickle out. They're hammering on it a little bit after the market closed, and they're talking about Greece. And again, Greece might leave the euro. Greece might default. I mean, as long as you have been watching my videos, I have been talking about Greece, we've been talking about Greece for years. I mean, I think it's been since 2011 we've been talking about Greece. It's redonkulous. I mean, Greece is going to default. It's not going to default. It's every other month. Anytime the market goes down, Greece becomes a convenient excuse. So case in point, if the market does sell off a little bit, Greece will be one of the reasons, whether it's tomorrow or Monday or Tuesday, whatever the case is. But back to the wall of worry, the more negative the news gets, the higher the market goes. The market loves bearish news. Okay, it's such an irony that nobody picks up on. It's mind-boggling. The news gets bearish, people get bearish, and the market goes higher. Because as long as the market is extremely bullish, there's no more buyers. If they've sucked everybody in, who's left to buy? That's at the point when you get bearish. It's the opposite of what the majority of people think it is. And that's the contrarian way of thinking, right? If the market is bearish and there's people trying to short the market, and then every time the market goes up, they cover and they keep hammering on the downside verbally and also by shorting the market, that means that there's people who are short the market, and therefore when the market goes a little higher, you have what's called forced buying. Okay, short covering is forced buying. Forced buying sends prices higher. So as long as the sentiment is slightly bearish, I like that. That means higher prices are coming. It's just a phenomenon that's been since the beginning of time. I didn't make it up, okay? And nobody picks up on it. And it's one of the biggest ironies in the market that I just have never been able to figure out why the simplest thing is hard to pick up on. It's mind-boggling. Okay, so you got the picture in the stock market, you have the numbers, you have the wall of worry, where I think there's a big move coming, and as long as we close above 2105, then that move is coming up, and that move could be anywhere from 50 or more to 100 points on the S&P on the upside. Not in one day, but just as an upside target. So if you want to look at upside targets, we know where they are in the SPY. We know the 212.97. We know 215, I've told you. And then beyond that, we'll talk about it when and if we get to those levels. Okay, let's go over to the gold market. Nothing doing. Gold was down a couple of dollars today. Still think there's higher prices coming. We just have to wait for them to play out. It's just one of those things that unless the market tells us something else is developing on the downside, and for one, a close below these moving averages on a daily basis, and then a close below this low here, that's at 1183.50, that would tell us something else is developing most likely. But for now, it's just a waiting game. 1212 is our next upside target. Beyond that, it's 1241. We have to step there one step at a time, and the gold market is not necessarily always an easy trade, but that's where we are. Nothing new, just a reiteration of what we've been discussing. Let's go over to the oil market. Now, oil tried to sell off today, but then it reversed, and it's beating on the top end of the channel and pierced above it today again. And, I don't really buy into the story that the weak dollar is pushing oil up, because the dollar was weak when oil was down earlier in the day and at other points in time. But nevertheless, this tells me that there's a pretty good bid under oil, and it tells me that oil wants to go higher, and it tells me that we may see the $58, maybe even $60 level before this move is said and done. And I can tell you that 58, I get interested in a short. 60 is a stone cold short. Right now, I'm not so interested in shorting this market. It looks like it wants to go higher, so I'm going to let it play out. And if you look at the hourly to get another picture, this is kind of two charts in one. I can make a case this is bullish and bearish all at the same time. So there's really nothing. I don't have a trade to say that we have to do something. I just have targets that if we did achieve, that I would get interested in taking a contrary view, in this case be on the short side, if we got to the neighborhood of $58 to $60 a barrel. Up until that point, I'm going to leave it alone and just let the market give me a signal that it wants to do one thing or the other. Let's flip over to the U.S. dollar. And the U.S. dollar, I'm going to go over to the daily chart, and the dollar did exactly what I said it should do. In fact, it actually did a little bit more. I said the dollar was going to go down to the 98 area. The dollar went down to 97.47, and we closed just under the 98 area. So if you look at the hourly chart, it was kind of as advertised, right? I gave you the short at $100. I said if we close below 100, any hour below 100, this is the other day I told you this when it was at 100. Any hourly below 100 was going to produce lower prices, and I really gave it to you in increments of $1. I gave it to you at 99 and I gave it to you at 98. So there you have it. I don't have any lower prices in my work that I've calculated. That doesn't mean there can't be lower prices, but that's what I have. Now, the bigger picture, I'm looking at buying the dollar in this zone if we can get it there, but I don't have anything telling me it's getting there, right? So, but if it does, I want to be a buyer. Or if I see some kind of a definitive bottoming signal, turning point, reversal in the market that tells me that I should be buyer, I want to be a buyer because we know there's higher prices coming in the dollar throughout the remainder of this year into most likely 2016. And I've got the dollar going as high as 110, maybe 111 on the upside. So, one might say, well, why don't you just buy it here? Well, because I like to get lower prices. That's why. But I'm watching it and I'll just keep you in the loop day by day and we'll see how it plays out. I think that's it. It's all I have for tonight. I think I gave you everything I had. It should be good information. Hopefully it's helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.